Hello friends, so in this video we'll cover about the Basel Committee history and guidelines. So let us first discuss the content of the video. So in the video first we'll cover about the overview of the Basel Committee, commonly known as the BCBS, Basel Committee on Banking Supervision. Then we'll cover about the Basel I, Basel II, Basel III Accord, and recently the committee has published Basel 3.1 as a um, final reforms to the Basel III, which we'll discuss later in the slide. And then we'll cover about the different banks risk measurement approach and the Basel pillar overview. Then what are the tier 1, tier 2 capital of bank, and what are the minimum requirement of banks to use IRB approach and its pros and cons. Let's first start with the overview of the bank. First, we'll walk through the history of the committee. So first, the committee was established by the central bank governors of G10 countries at the end of 1974. So there was a notable failure for a bank named Hallstatt Bank. So following to which the committee was established to investigate the issues in the banking framework and enhance the bank policies so that in future this type of event will not occur. And as a banking failure is a major disaster in the economy because it will impact the country citizen deposits money, and also it will impact different operations of the company like export import operations. So this BCBS was headquartered in the BIS, Banks for International Settlement, is the one of the oldest financial institutions, and this BIS was established around 1930s. And the Basel Committee was set up around the end of 1974. So the committee has further expanded its membership from G10, like the global 10 countries, to the 45 institutions, and which comprises of 28 jurisdictions. Further, the committee has established a series of guidelines for bank regulations, which are commonly known as Basel I, Basel II, Basel III, and the recent Basel 3.1. First, why the committee is needed and what what the guidelines will do and how it helps in maintaining a banking supervision across the globe. So first, the committee was created to enhance the financial stability by improving the quality of banking supervision worldwide. Like before this, there were no international supervisory body who governs the banking work, bank workings and capital calculation and all. And further, the committee provide a regular cooperation on banking supervisory matter. So here, the member country participate to discuss on the different policies and framework that banks need to implement in order to avoid any future turmoil or to combat any economic disturbance in the future. Basel I Accord. So Basel I was first introduced in 1988 until 1997 it was there, and post that there were Basel II Accord which were published by the Basel Committee. So in Basel I Accord, it defined the riskiness of asset and banks to calculate its risk weighted asset. So suppose a bank is giving loan to a customer, so based on the total loan value, bank needs to calculate like how much its value is in risk, the corresponding risk weight asset based on the different type of customer, and accordingly bank needs to calculate its capital requirement. Like if there are any credit loss happen, then to absorb those loss, this capital can be used. So these guidelines are defined in the Basel I that banks need to keep 8% of its risk weight asset, and to calculate this risk weight asset, Basel I introduced a standardized approach like for different portfolio, for corporate portfolio, for banks portfolio, for retail customer portfolio. For this type of portfolio, banks need to calculate RWA based on the different brackets like percent. So once bank will get the RWA value based on the different type of loan it has given to the customer. So 8% of that RWA value banks will need to keep as its capital to absorb any losses. So these are the main points for the Basel I Accords. So let's discuss what are the shortcomings of it and why Basel II is needed. So first in Basel I there is very coarse classification of asset. Like only four class of asset is defined and correspondingly RWA is defined. First class is sovereign debt or loan to central government or central banks, and then like loan to other bank or residential mortgage or other loans. So these are the four type of classes, and also there is single RW defined for each class. So even if suppose for retail mortgage, like if a customer has a good credit profile, then or a customer has a bad credit profile, then for both of this type of customer, same RW bank is calculating as per the Basel one. So this is one shortcomings of like it is not able to identify the risk of the customer in each of the classes. So and the other is only credit risk is defined in the Basel one and not considering other risk of the bank. So general there are other banking risk related to the operational and market risk. So which is not defined in Basel one, and Basel one calculate RW just based on the credit risk. And also Basel one not able to institutionalize the risk sensitivity. There is not taking care of impact of securitization, which we will discuss in next point, and it is making an adverse effect. So what is the impact of securitization? So because because of the straight RWA for each classes, suppose for residential mortgage, the RWA is 50% for all type of customers. So there is a regulatory arbitrage opportunity for the bank. So what it means? So banks now dividing its portfolio into multiple parts, and based on the customer characteristics, banks able to differentiate customer as a risky or less risky customers. So this is what has been defined in this regulatory arbitrage pointer. So suppose that banks has 1,000 million loan, and now the banks as per the Basel I record needs to keep a certain capital to absorb its losses. So as per Basel I for the home loan, the RW is 50%. So bank needs to give 40 million as a equity if bank is having home loan. So what banks are doing, or banks have the opportunity of this regulatory arbitrage, banks is further dividing this 1,000 million home loan into 10 subpart such that each subpart is less risky than other. So the 10 subpart is divided into is it's separated into ascending order based on its risk type, and top 50% of the least risky customers. So that bank is converting into bond, and that bond is backed by its like monthly payment, like generally it is called as a mortgage backed securities. Now bank has only 500 million of home loan as a portfolio, because for the rest 500 million bank has converted it to bond and sold it in the market. So here what is happening in the current case, bank still has a 1,000 million loan, but bank has converted that loan in such a manner it is only taking 500 million loan as a direct loan and converting the rest 500 million into a bond. So that bond will also is that bonds bank is selling in the market and getting the money, and bank is earning an interest margin between this in this mortgage backed securities. So this way banks need to keep capital only on the 500 million which bank is directly exposed to as a home loan. So in this way bank is minimizing its capital requirement to 20 million and saving 20 million here, and that bank is utilizing to further lend more, because for a bank the main business is around the lending of the money and to, to earn interest on it. So in this way bank are having more capital with it, which is helping banks to further boost its business. But from a regulatory point of view, it is making bank more risky, because the 500 million loan which bank has in form of home loan, that is a risky customer, that comprise of risky customer, because less risky customer already bank has sold as a form of bond. So in this way, the main objective of Basel I was to make the bank less risky and have a sufficient capital to absorb any losses at the time of economic disturbance, but it is making bank more risky. So there was a certain reforms needed in Basel I guidelines, and thus Basel II was introduced. So this is all about the Basel I. In the next video, I will cover about the Basel II.